Let's just cut right to it. That traditional financial safety net, the one our parents might have had, it's gone.
It's completely gone.
I mean, if you're out there relying on a pension, you have to face a pretty cold, hard reality.
Those plans are, for the most part, extinct.
Mm.
That entire responsibility for your financial future,
Oh.
it has shifted. It's on you now.
It's all on your shoulders, and you're living longer than any generation before, so you're potentially facing, what, a 30-year retirement?
At least. And all while the markets are delivering this just stomach-churning volatility.
Gray eye, which feels completely out of our control.
And that's the point. That combination of longevity and market uncertainty brings us to the core truth of managing your wealth today. Real financial control.
Yeah.
It boils down to mastering the two critical things you can actually control.
Yeah.
Taxes and risk.
Let's talk about taxes first, because people hear taxes and they tune out. But this is where the real money is.
Absolutely. Taxes are fundamentally the hidden fee that just chips away at your wealth. Year after year, it's eroding your compounded returns. If you want a dependable, guaranteed boost to your net returns, controlling that liability is the most reliable strategy you have.
We're not talking about saving $5 on coffee here. We're talking about 5, maybe 6-figure savings over your lifetime.
Easily.
So today we are cutting through all that noise. We're diving deep into some highly technical stuff. Tax law, updated as of June 2025 federal rules, and the actual Nobel Prize-winning math of modern portfolio theory.
It sounds intimidating.
It does. But our mission here is to take these confusing, honestly overwhelming options, the tax code, the physics of investing, and just distill them. Break them down into crystal clear, actionable steps. The goal is a low-tax retirement and a portfolio that's truly resilient.
This is your shortcut.
It's the ultimate shortcut to being well-informed. But before we get into the 3 tax buckets that really determine your future, make sure you subscribe to Money Mindset right now. You do not want to miss a guide like this one.
Okay, so to start, we have to establish the foundational framework. Without this core concept, any attempt at optimization is just, it's just guesswork.
And what is that framework?
We call it the 3 tax buckets. It's all about strategically diversifying where you hold your money based on when you think you'll need it and, crucially, when you want to pay the tax.
Okay, let's unpack this. It sounds simple, right? 3 buckets. But the timing of that tax payment, whether it's today, tomorrow, or maybe never, that dictates everything about your future spending power.
Precisely. You are essentially trying to time your tax payments against your own future income. It's a strategic game.
So what's the first bucket?
The first bucket is tax deferred. This is the classic. It's the most common retirement vehicle out there. Think your traditional 401k or a traditional IRA.
Right, the one most people have at work.
Exactly. And the core benefit comes right away, up front. Your contributions are tax deductible. So you're putting pre-tax dollars in, which lowers your taxable income today, and those earnings compound and grow tax-free for decades.
That immediate deduction is great, especially if you're a high earner right now and you want to reduce your current tax bill. But there's always a catch, right? What's the catch here?
The downside is that the government eventually gets its cut. And they have mandatory rules about when. When you take the money out in retirement, every single dollar, not just the growth, the principal too, is taxed as ordinary income.
At whatever your tax rate is at that time, which could be higher.
Could be much higher. And here's the critical part. They impose RMD's required minimum distributions starting at age 73. This is the government forcing you to withdraw money and pay tax on it.
Whether you need the cash or not.
Whether you need it for living expenses or not,
Yeah.
you have to take it out.
And that RMD trap is a massive issue. We'll get into this later, but it can push a retiree who feels comfortable into a much higher tax bracket, completely by surprise.
It's the main driver for a lot of tax planning.
Okay, so that's bucket 1. Taxed later. What's the second bucket?
The second is what we often call the ideal, the tax-advantaged, or simply the tax-free bucket. This is your Roth IRA and your Roth 401k.
The Roth. Everyone loves the Roth.
And for good reason. You fund this with after-tax money, so you don't get that immediate deduction on the contribution.
So you pay the tax today.
You pay the tax today. But the payoff is immense. The earnings grow completely tax-free, and if you meet the requirements, the qualified distributions in retirement are tax-free forever.
Forever. That's the key word. So the Roth is often seen as the better choice, especially for younger investors, right? People who think they'll be in a higher tax bracket later in life.
That's the conventional wisdom, yes.
Yeah.
And a major, often overlooked pro for the Roth IRA specifically is that it has no RMDs.
Oh, that's huge.
It's a game changer. You can let that money grow indefinitely. You can pass it to your heirs tax-free, or just keep it as this massive liquid emergency fund without the government ever forcing your hand.
So what's the drawback? It sounds perfect.
The primary drawback is access. Contributions to a Roth IRA often have income eligibility restrictions, which can limit access for the highest earners.
But the Roth 401k doesn't have those same limits, does it?
Correct. The Roth 401k at your workplace does not have those income limits, which makes it an excellent alternative for high-income folks.
Okay, so we have taxed later with the deferred bucket and taxed never with the advantage bucket, assuming your withdrawals are qualified. That just leaves the everyday account.
That's the third bucket, taxable. This is just your standard brokerage account, a regular savings account, any mutual fund you own outside of a retirement plan.
The one you can open up on an app on your phone in 5 minutes.
Exactly that one. Contributions are after tax, there's no immediate tax advantage, and the earnings, they're taxed every single year.
So you're getting a tax bill for interest, for dividends, for any capital gains you realize when you sell.
Every single year. That yearly tax bill is the big drawback. It creates that constant tax drag on your compounding growth.
But it must have some advantage. Why would anyone use it?
Flexibility and liquidity. That's the pro. There are no age restrictions on accessing your money. And, importantly, if you hold assets for longer than a year, you get long-term capital gains and qualified dividends.
And those are taxed at much lower rates than ordinary income.
Often much, much lower, which could be a huge advantage. The final catch, though, for high-income earners is that all these investment earnings might also get hit with the 3.8% net investment income tax, or NIIT. It's an extra tax on top of the standard capital gains rate.
So the big takeaway here is that there's no single best bucket. You need a mix, a custom blend.
It has to be a custom mix. It's tailored to your age, your time horizon, and most importantly, your forecast for what your tax brackets are going to look like in retirement.
And that framework, those 3 buckets, leads us directly to what might be the single most powerful tool available, the hybrid.
The Health Savings Account, or HSA. We call this the triple threat, precisely because it combines the best benefits of both the tax-deferred and the tax-advantaged buckets into one account.
Before we get into the mechanics of it, we have to talk about why this account should be an absolute priority. We need to talk about the frankly shocking cost of healthcare and retirement.
The numbers are startling, and most people just ignore them in their planning. But research, solid research from places like the Employee Benefit Research Institute, it indicates that a 65-year-old male-female couple, they need a stunning $301,000 in savings if they want a 90% chance of covering all their medical expenses throughout their entire retirement.
Wait, say that number again?
$301,000.
Just for healthcare. That's on top of everything else you need to save for. And we know that something like 20% of current retirees say they haven't saved enough just to cover medical costs alone.
It's a massive looming expense, and the HSA is the vehicle specifically designed to tackle it head-on.
Okay, so it's a supercharged savings vehicle. What are the rules?
Yeah.
Who can get one?
To qualify, you have to be enrolled in a high-deductible health plan, an HDHP. And you cannot be enrolled in Medicare. That's a common barrier. But if you do qualify, the benefits are, well, they're unparalleled.
Okay, let's nail down this triple threat advantage, step by step. What's the first threat?
First, the contribution. It is deductible. It reduces your adjusted gross income just like a traditional IRA. So you save on taxes today, right off the bat.
Threat 2.
The earnings. The money, if you invest it, grows completely tax-free inside the account, just like any other retirement account.
Okay, so far so good, but that sounds like a traditional IRA. What's the game changer?
Threat 3. This is the Roth-like benefit. Distributions for qualified medical expenses are also completely tax-free.
So you get a deduction going in.
Tax-free growth while it's invested.
And tax-free withdrawal when you spend it on healthcare.
No other investment vehicle in the entire tax code offers that three-way advantage. And as a bonus, there's no 10% penalty for using the funds on qualified medical expenses before you're 59 and a half.
That's just an unbeatable combination. And the contribution limits are pretty substantial, right? This isn't just a small-time spending account.
No, absolutely not. For 2025, individuals can put in up to $4,300 a year. Families can contribute up to $8,550.
And there's a catch-up, too.
A $1,000 catch-up contribution if you're 55 or older. This is a serious amount of tax advantage space. And you can keep contributing even after you retire, as long as you're not on Medicare yet.
Okay, now we have to get to the advanced strategy. The game-changing takeaway that turns the HSA from a simple health account into really a supplemental tax-free retirement fund. I'm talking about strategic reimbursement.
This is the critical insight. This is what separates the well-informed from the average saver.
Yeah.
Most people use their HSA as intended. They get a medical bill, they pay it, and they immediately reimburse themselves from the HSA.
Right. That seems logical.
It does. But the rule just says you can reimburse yourself at any point in the future,
Yeah.
as long as the expense happened after you open the HSA.
Hold on, let me push back on that. Are you seriously saying I can pay a $5,000 medical bill today out of my own pocket, save the receipt in a folder for, what, 20 or 30 years?
That's exactly what I'm saying.
And then reimburse myself tax-free decades later? How does the IRS allow that kind of time lag?
They absolutely do. The statute does not require immediate reimbursement. So this allows you to adopt a powerful strategy. You pay all your current qualified medical expenses out of your taxable account, your checking account, whatever. You just don't touch the HSA.
And you save every single one of those receipts meticulously.
Meticulously. Let's use a clear example. Let's say you're 35. You have a major dental procedure. It costs you $6,000. You pay it out of pocket today, and you save that receipt digitally.
And meanwhile, the $6,000 you didn't take out of your HSA is still in there, invested, and it continues to compound and grow tax-free for the next 30 years.
Exactly. Let's just assume a pretty standard 8% annual return over those 30 years. That original $6,000 goes into roughly $60,385. Now, you're 65. You're in retirement. You need some cash flow. Maybe you want to avoid tapping an IRA and triggering a bigger tax bill, or you want to delay taking Social Security. Just pull out that entire $60,385 tax-free.
Simply by presenting the 30-year-old receipt for $6,000 as the justification.
That's it. It is a reimbursement for a qualified medical expense.
That's an incredible return on just being disciplined. You've essentially turned a $6,000 expense into a $60,000 tax-free supplemental retirement fund.
It's the closest thing to a truly unrestricted tax-free money pool that the tax code allows. And that's strategy number 1 down. Capitalize on the triple threat HSA.
That is immensely actionable. Okay, let's move into our next section, which is all about managing assets in that third bucket, the taxable account, and how to optimize your tax brackets. Starting with capital gains, this is where we learn how you can potentially turn profits into zero tax events.
This is crucial, and we need to dispel a common belief right away. Most investors just assume that their long-term capital gains rate is 15%.
Right. That's the number you always hear.
It is. And while it's the common mid-tier rate, the reality is there are actually 3 tiers, 0%, 15%, and 20%. And understanding that 0% threshold is the key to some really aggressive tax planning, especially for retirees.
The idea that you could sell an asset that's appreciated massively and pay zero federal tax on the gain, it almost sounds too good to be true. Let's look at the 2025 thresholds because that defines the target.
Okay, so for long-term capital gains, and remember, that means you've held the asset for more than a year, the 0% tax rate applies up to specific taxable income levels.
And taxable income includes everything, right? Wages, interest, pensions.
All of it. For a single filer in 2025, that 0% rate applies up to $48,350 of taxable income. For a married couple filing jointly, the 0% rate applies all the way up to $96,700.
Okay, so let me get this straight. If I'm a married couple and my total taxable income, let's say from a small pension and some interest, is $50,000, I have $46,700 of room left in that 0% capital gains bracket for the year. I could realize that much in gains and pay zero tax.
Exactly. And this is why capital gains planning isn't just about selling. It's about timing the realization of those gains perfectly. You want to do it when your ordinary income is low.
Which leads right into strategy 2, managing capital gains rates. And this has 2 parts that really work together, right?
2 symbiotic parts.
Yeah.
Capital loss harvesting and capital gain harvesting.
Let's start with loss harvesting. This is what you do when an investment goes down. It's about turning a bad investment outcome into a good tax outcome.
It's just simple addition and subtraction to minimize your tax bill. If you have some appreciated assets you need to sell for a profit this year, but you're also sitting on other assets that have lost value, you should realize those losses in the same year. It's a common mistake to take a big gain this year and wait until next year to sell the loser. You just paid tax unnecessarily.
Give us the example of Terry. I think that illustrates how it works as an immediate tax shield.
Okay, so let's say Terry is a mid-tier taxpayer. He sold stock ABC for a gain of $10,000. Normally, that gain would be taxed at his long-term rate, probably 15%. which would be a $1,500 tax bill.
Okay.
But he also holds stock XYZ, which has fallen in value. He sells it for a loss of $10,000 in the same year. The $10,000 loss perfectly offsets the $10,000 gain.
And the results?
Zero capital gains taxes owed. The market loss is completely offset by the tax savings on the gain.
That makes sense when the loss and gain match up. But what happens if your losses are bigger than your gains?
If you have excess net capital losses, let's say you have a net loss of $15,000 for the year, the tax code gives you another benefit. You can use up to $3,000 of that net loss annually to offset other ordinary income.
Wait, you said other income, not just capital gains.
Yes, ordinary income, like your wages, your interest income, the highly taxed stuff.
So if I'm a single filer making $70,000 a year and I have a $15,000 net capital loss, I can immediately reduce my taxable income by $3,000 this year. That saves me my marginal tax rate on that income.
Precisely. And the remaining $12,000 of the loss isn't gone. It's carried forward indefinitely to offset future gains or income. You're basically creating a valuable tax asset that pays dividends later.
You just have to remember to use it every year.
You have to. You can't go back and claim it retroactively.
Okay, so that's harvesting losses. Let's flip it to the more proactive side. Capital gain harvesting. Some planners call this the sneak down maneuver.
This is where you strategically realize gains when you expect your taxable income to be lower. It's especially powerful for people entering retirement or anyone in a low-income year. Maybe you took a sabbatical or are between jobs.
Right, so if you're a high earner today, you might be looking at the 20% capital gains rate.
But if you know your income's going to drop dramatically in early retirement, say in those years before you start collecting Social Security or RMDs, you might be able to realize those same gains at the 15% rate, or even better.
At the 0% rate.
At the 0% rate. You are intentionally cleaning out those highly appreciated assets from your taxable bucket during these low-income windows. You're paying little to no tax now, rather than waiting until RMDs or Social Security kick in and inevitably push you back into a higher bracket, maybe hitting that 20% rate later on.
So for many retirees, that 0% rate isn't just a fantasy. It's absolutely achievable with some good planning.
It is. With proper timing, it's very achievable.
This idea of strategic timing brings us perfectly to strategy 3, the power of Roth conversions. This is the ultimate tool for bracket optimization, and it's designed specifically to proactively kill the threat of future RMDs.
The core idea here is really simple. You're moving money from your tax-deferred traditional IRA, where taxes haven't been paid yet, over to your tax-advantaged Roth IRA, where all future withdrawals will be guaranteed tax-free.
And to do that, you have to pay the toll.
You pay the toll. You pay the full tax liability now at your ordinary income rates on the entire amount you convert. But, and this is crucial, there's no 10% early withdrawal penalty, no matter your age, because the money's staying within the retirement system.
Okay, so the RMD trap is the real danger we're fighting here. Let's look at Jane's hypothetical income profile. I think that really visualizes the problem.
Right, so imagine Jane retires at age 63. Her taxable income drops off a cliff because her salary is gone. She might be living off a small pension, some interest income, maybe pulling a little from her taxable account. Her tax rate is low. Maybe she's in the 12% or 22% bracket.
She's feeling good. Low tax retirement.
Then at age 67, her income ticks up again when she decides to start collecting Social Security.
Okay, that's normal, but the real problem starts to accelerate a few years after that.
Exactly. At age 73, the RMDs, the required minimum distributions, kick in. And those RMDs force mandatory withdrawals from her big traditional 401k and IRA balances. We're talking tens of thousands of dollars a year, potentially.
So you combine those RMDs with her Social Security and any other income.
And her total taxable income just skyrockets. It can easily push her into a high tax bracket she never ever anticipated, purely because the government is mandating the distribution. She's getting taxed just because she's being forced to take the money out.
So the smart move is to intentionally pull that income forward. You accelerate it into those gap years.
The conversion window. That sweet spot between when she retires at 63 and when the RMDs and Social Security start to hit between 67 and 73. That's when her taxable income is otherwise at its lowest.
You're creating a controlled burn.
A controlled burn is a perfect analogy. By converting a calculated portion of that traditional money to a Roth during those low-income years, she pays the tax at a manageable low rate, now say 12% or 22%.
And in doing so, she shrinks the size of her future RMDs.
She shrinks the RMDs and ensures the money she converted is permanently tax-free. It protects her from potentially hitting 32% or 35% tax rates in the future. The whole strategy is about intentionally filling up your lower tax brackets today to avoid being crammed into the higher brackets tomorrow.
This is a powerful concept, but it's really easy to get greedy. You could accidentally push yourself into a high bracket during the conversion itself, which would defeat the whole purpose.
It's a very common mistake.
Which brings us to the importance of tactical spreading. Let's use Dan's example to show how this works and how to avoid that mistake.
Okay, so Dan is retired and he's single. His current taxable income from all his sources before any conversion is $131,900. Under the 2025 federal rules, that puts him comfortably in the 24% tax bracket.
And he decides he wants to convert a big chunk from his IRA to his Roth, say $75,000.
So he does it all in 1 year. If we add that conversion amount to his current income, his total taxable income jumps from $131,900 up to $206,900. to $6,900.
And there's the trap.
There's a trap. The 24% bracket for a single filer cuts off at $197,300. By converting that full $75,000, Dan has pushed $9,600 of that conversion money past the 24% limit and right into the 32% tax bracket.
Ouch! That's an immediate hefty tax increase on that portion of the money.
It is, and it can affect other tax credits and phase-outs too.
So the spreading tactic is the solution. How does Dan optimize this $75,000 conversion without breaking through his target bracket?
Instead of one massive bracket-breaking conversion, he spreads it out. He could calculate the exact headroom he has in the 24% bracket, which is about $65,000. But to keep the math simple and stay safe, he just decides to convert around $25,000 each year for 3 years.
So if he converts just $25,000 a year, his total income is only $156,900. That's still well below that $197,300 limit. What's the actual dollar cost of making that mistake and doing it all at once?
The tax difference is significant. If he does it all in 1 year, he pays 24% on most of it, but that $9,600 is taxed at 32%. That extra 8% difference costs him an extra $768 right there. By using the 3-year plan, he pays a flat 24% on the entire $75,000.
So he saves almost $800 just by being patient.
He saves well over $1,000 in total taxes. When you factor in all the cascading effects, he completely avoids that marginal tax bite.
That's a perfect example of how tax planning isn't about avoiding tax entirely. It's about optimizing when you pay it, often down to the exact dollar, to avoid crossing those bracket thresholds. It's high precision work.
And this principle is universal. You see high-income earners doing this too. They might be in a peak earning year, but know they'll hit the top 37% bracket later with RMDs.
Right.
So they use Roth conversions now to fill up their 32% or 35% brackets. They're paying a high rate now, but guaranteeing they never have to face the absolute highest rate on that money in a decade or two.
Okay, we've covered a ton. Managing a tax buckets, leveraging the HSA, optimizing capital gains, using Roth conversions. That's a serious stack of knowledge focused on income.
Right.
Now let's talk deductions. Specifically, how do you maximize them when the standard deduction is so high?
This is strategy 4, maximizing deductions through bunching. The whole landscape for this changed with the 2017 Tax Cuts and Jobs Act. It dramatically increased the standard deduction.
It nearly doubled it for individuals and almost tripled it for families. So for 2025, a married couple filing jointly gets a standard deduction of $30,000.
And that high bar is the problem we're trying to solve. If all your specific itemized deductions, charity, property taxes, mortgage interest only add up to, say, $28,000.
You're forced to take the $30,000 standard deduction.
You are. And you completely lose the value of that $28,000 in deductions forever. You haven't really saved anything. You've just chosen the higher of the two options the law gives you.
So bunching is the technique where you strategically consolidate all the itemized deductions that you can control, like your charitable giving or maybe some state tax payments, into a single year. You do that to clear that high $30,000 standard deduction bar.
Precisely. And then in the off years, the intervening years, you just go back to taking the standard deduction. You create this cycle of alternating between itemizing and taking the standard. Let's look at Stan and Judy to see the math in action. They're a married couple, both age 64.
Okay, walk us through their normal, non-bunched situation first.
Stan and Judy's normal annual itemized deductions are pretty typical. They have about $8,000 in property and state taxes, which is under the $10,000 SALT cap. They have $6,000 in mortgage interest, and they make $10,000 in charitable donations every year. That totals $24,000.
Since $24,000 is less than the $30,000 standard deduction, they just take the standard deduction every year. So over 2 years, they claim $60,000 in deductions, no optimization at all.
Correct. Now let's see what happens when they employ the bunching strategy. In year one, they take their usual deductions, but they accelerate two items that they can control. First, they prepay $2,000 in property taxes for the following year, which keeps them at the $10,000 SALT cap for the year.
Okay.
Second, and this is the big one, they accelerate their entire year two charitable contribution of $10,000 into year one.
So in year one, their itemized deductions are the normal $24,000 plus the $2,000 in prepaid tax plus the extra $10,000 in accelerated charity. That adds up to $36,000.
Exactly. And since $36,000 is way more than the $30,000 standard deduction, they itemize. They claim the full $36,000 in year one. That's a huge win.
But then what happens in year two? Their deductions will be lower because they pulled those payments forward.
They will be. In year two, because they already paid some tax and made the charity donation, their itemized deductions fall back down to their base level. Since that's below the standard deduction, they just claim the standard deduction of $30,000 in year two.
So let's add it up. Over the 2 years, by bunching, they claimed $36,000 in year one and $30,000 in year two. That's a total of $66,000 in deductions.
They created an additional $6,000 in deductions out of thin air, just by timing the payment of their property taxes and charitable donations. That $6,000 creates real tax savings. And while we focused on charity and taxes, you could do the same thing with, say, large medical expenses if they exceed that 7.5% of AGL threshold.
This has been a masterclass in controlling the tax environment, the single most controllable cost in your entire financial plan.
We focus entirely on minimizing those costs.
Okay, let's pivot now. This is a big transition. We've talked about controlling the tax bill. Now let's get into the second critical element of financial mastery, the actual science behind how you arrange those investments in the first place. We're moving from tax efficiency to portfolio efficiency, the deep math that ensures you don't lose money to unnecessary market volatility. This is strategy 5, asset allocation and diversification 101.
To really appreciate portfolio efficiency, we have to start with the simplest concept there is, diversification. It seems obvious, but the mechanism behind it is mathematically rigorous.
Let's use the street vendor analogy. It
Right.
captures the essence perfectly and cuts through all the jargon.
Okay, think about a street vendor who sets up a cart and sells two things, umbrellas and sunglasses. To an outsider, that seems inefficient. Why carry two such opposite products?
Because they're diversifying their revenue stream. When a sudden rainstorm hits, umbrella sales go through the roof and sunglass sales disappear.
And when the sun is scorching hot, the reverse is true. By selling both, the vendor smooths out their daily sales volatility. They make it so they rarely have a truly terrible day overall. It reduces the risk of losing money on any given day.
And that is the absolute foundation of asset allocation and diversification.
It is. You divide your portfolio among different asset categories, like stocks, bonds, and cash, because historically, their returns do not move up and down at the exact same time. This lack of perfect correlation smooths out your portfolio's overall volatility. It reduces your risk without necessarily sacrificing your potential return.
And the specific mix of assets you choose, your allocation, depends on two really personal factors, right?
Your time horizon and your risk tolerance. If you're 25 with a 40-year horizon until retirement, you can afford way more volatility. You can have riskier assets because you have decades to wait out slow economic cycles.
But if you're saving for a down payment on a house next year, you need minimum risk.
Exactly. And risk tolerance is just your psychological ability, your willingness to lose money in short term for the potential of greater returns over the long term.
Let's break down the three major asset categories because they are the building blocks of any portfolio.
Okay, first you have stocks. Stocks are the growth engine. They are the heavy hitters. They offer historically the greatest risk and the highest potential long-term returns. But they are volatile. A diversified basket of large company stocks has lost money roughly 1 out of every 3 years. So they're appropriate for long time horizons.
Then you have bonds, which are like the shock absorber for the portfolio.
Perfect way to put it. They are generally much less volatile than stocks, and they provide more modest fixed returns. They're essential for reducing risk and preserving capital as you get closer to your goal. But a huge caveat, not all bonds are created equal. High yield or junk bonds carry significant risk and often act more like stocks than traditional government bonds.
And finally, the safest category.
Cash and cash equivalents. These are the safest investments, offering the lowest return. The chances of losing your original capital are extremely low. The main risk here isn't market loss, it's inflation risk.
The risk that inflation will just eat away at your purchasing power over time.
Exactly. So cash is only really appropriate for your immediate needs or very, very short-term goals.
So the magic of diversification, just like with the street vendor, is picking the right blend of these to limit your losses and reduce the size of those wild swings. It's about not having all your eggs in one basket that might react badly to, say, a recession or a sudden interest rate hike.
And that diversification has to happen at two levels. It's not enough to just do one. It's between asset category stocks versus bonds and within asset categories. For instance, owning dozens of different stocks or owning international funds versus domestic funds.
Okay, so here's where it gets really interesting. We're moving from the intuitive wisdom of the street vendor to the foundational math that actually proves it. Modern portfolio theory, MPT. This isn't just advice. This is the physics of investing.
This is the mathematical framework developed by Harry Markowitz back in 1952. He later won the Nobel Prize for it, and it's the conceptual backbone of pretty much all institutional investing today.
What was the core revolutionary insight of MPT? What did Markowitz change about how we think about risk?
Markowitz proved that an asset's risk should not be judged in isolation. It should be judged by how it contributes to the portfolio's overall risk and return. He created the quantitative measures for this. MPT uses variance, or standard deviation, as its measure of risk, how much an asset's return swings around its average. But crucially, it uses covariance.
Okay, explain covariance simply. What is that?
Covariance measures how two assets dance together. If asset A and asset B both tend to go up when the market goes up, they have high positive covariance. If asset A tends to go up when asset B tends to go down, like our umbrellas and sunglasses, they have negative covariance. And MPT seeks out assets with low or negative covariance because adding them to a portfolio minimizes the overall volatility.
So MPT is all about finding that optimal mix of assets with different correlations to get the best result. And graphically, MPT uses what's sometimes called the Markowitz bullet. Let's try to visualize that.
Imagine a scatter plot graph. The vertical axis is expected return. That's the good thing we want more of. The horizontal axis is volatility, or risk, the bad thing we want less of. Every single possible combination of assets can be plotted on this graph.
And they form a specific shape.
They form a hyperbolic shape. And the upper left edge of that shape is what we call the efficient frontier.
That curve is the goal.
It is the optimal set of goals. Any portfolio that lies on that curve offers you one of two things. Either the highest expected return possible for a given level of risk, or conversely, the lowest possible risk for a given target return. If your portfolio is inside that curve, you're taking on too much risk to the return you're getting. You're being inefficient.
And the very tip of that curve, the absolute leftmost point, that has to be the sweet spot for risk minimization.
That is the global minimum variance portfolio, GMVP. It is the one portfolio combination with the absolute lowest possible risk you can achieve with risky assets. It might sacrifice some return potential, but it gives you maximum stability. And MPT tells us the exact weights of each asset needed to achieve that mathematical minimum risk.
So MPT mathematically proves the diversification free lunch we talked about with the street vendor. How does the math specifically show that free lunch benefit?
The math proves that the standard deviation or risk of a diversified portfolio will always be less than the simple weighted average of the individual asset's standard deviations. That's the free lunch. You lower your risk without giving up the expected average return of the parts.
And this only works as long as the correlation between the assets is less than 1, right?
That is the key. The correlation has to be less than 1. If two stocks were perfectly correlated, meaning they always moved up and down identically, there would be zero diversification benefit. You might as well just own one of them.
But in the real world, nothing is perfectly correlated.
Almost nothing, which means diversification almost always reduces your portfolio risk.
Now let's get into risk decomposition. This leads right to the core of how assets are priced, the capital asset pricing model, or CAPM. MPT tells us that total risk is split into two very different types.
This distinction is maybe the single most important lesson in all of investing. Your total risk is equal to specific risk plus systematic risk.
Let's start with specific risk.
Specific risk is also called idiosyncratic risk. This is risk that is unique to one single company. A CEO resigns, a factory burns down, a company gets hit with a surprise lawsuit. It's specific to that asset. And crucially, you can virtually eliminate this risk. You can diversify it away just by holding enough unrelated assets.
And why doesn't the market reward you for taking on that specific risk?
Because any rational investor can get rid of it for free or at minimal cost just by buying a diversified fund instead of a single stock. So the market provides absolutely no extra expected return for bearing it. It's uncompensated risk. It's the price you pay for being undiversified.
Okay, and then there's the risk you can't get rid of, the price of admission to the market.
That is systematic risk or market risk. This risk is common to all securities. It's driven by big macroeconomic factors you can't diversify away, like inflation, a global recession, changes in interest rates. And since you must bear this risk to participate in the market provides a risk premium for it.
And that systematic risk is measured by the famous metric, beta.
Correct. An asset's expected return is determined only by its sensitivity to the overall market. It's beta. A beta of 1 means it moves with the market. A beta of 0.5 means it theoretically moves half as much. CAPM formalizes this. The market only compensates you for bearing systematic risk.
Okay, so that brings it all together. You use diversification to eliminate the uncompensated specific risk, and then you accept the systematic risk, measured by beta, in exchange for getting the market's return.
Which leads us perfectly into how this theory is actually applied in the real world today. And the most effective translation of MPT is the core satellite portfolio construction strategy.
This moves beyond that old, tired debate of active versus passive investing. It combines them.
It blends them. The passive core is the bedrock of your portfolio. It's made up of broadly diversified, ultra-low-cost index funds or ETFs that just track the overall market performance or beta. This is where the vast majority of your assets should be. It's low-cost, diversified, and tax-efficient because of low turnover.
And then you have the active satellites.
The satellites are smaller positions used to tilt the portfolio toward a high-conviction sector or a style you believe in, maybe a specific technology, a geographic region, or small-cap value stocks. The goal here is to seek alpha, which is outperformance above the market average, but it usually comes with higher fees and higher risk. The satellites should be small enough that if they fail, your core remains stable.
And when we talk about discipline, I always think of Vanguard's 4 pillars. They really synthesize all this MPT math into something memorable.
They're a perfect real-world distillation. First, define clear goals. Second, ensure balance through diversification and asset allocation, which is MPT. Third, minimize costs. And remember that taxes are a massive hidden cost. And fourth, the hardest one, maintain discipline.
And that discipline brings us to the final mechanical task every investor needs to master, which directly fights that psychological urge to panic: rebalancing.
The discipline of rebalancing is mandatory. It's what keeps your risk profile aligned with your original goals and that efficient frontier you targeted. Markets move. If stocks have a great run for a few years, your portfolio will drift. If you started with a 60% stock, 40% bond target, it might naturally drift to become 80% stocks and 20% bonds.
And now your portfolio is way riskier than you originally intended. You're much more exposed to a big market downturn.
Exactly. Rebalancing is just the act of selling some of the winners, in this case stocks, and using the proceeds to buy more of the losers' bonds to bring the weights back to your original targets. It's crucial because drift moves your portfolio away from that efficient frontier you chose.
So it forces you to be a systematic contrarian.
It does. It forces you to sell high and buy low, which is so easy to say, but psychologically, it's incredibly difficult to do, especially when a winning asset feels like it can't lose.
So how do you do it? What are the methods?
There are 2 main ways. You can do it calendar-based, say every 6 or 12 months. That's simple and easy to automate. Or you can do it threshold-based, where you only act when an asset class drifts by a certain amount, like 5% off its target. But honestly, the easiest and most tax-efficient method is to just direct your new contributions to whatever is underweighted.
Now, MPT is the gold standard. It won a Nobel Prize. But we have to address its real-world limitations. It's not perfect.
Not at all. Despite its elegance, MPT in practice is often called an error maximizer. It is incredibly sensitive to errors in your inputs, especially your estimates for expected returns. If your guess about future returns is even slightly off,
Which it always will be.
it always will be, the MPT optimization engine will give massive weight to the assets you think have the highest returns, leading to poorly diversified, high-risk portfolios in reality. It's a classic garbage in, garbage out problem.
And the risk measure itself, variance, has been heavily criticized because it just doesn't align with how humans actually feel about risk.
Exactly. Variance is symmetric. It treats a huge positive return, which you love, as being just as risky as a huge negative return, which you hate. This completely fails to account for loss aversion. The psychological fact that a $1,000 loss hurts way more than a $1,000 gain feels good.
And finally, there's the famous critique from Nassim Nicholas Taleb. MPT assumes returns follow a normal Gaussian distribution, the bell curve.
This is a major structural critique. Critics argue that real market returns have fat tails. Extreme crashes or booms happen far more often than the normal distribution would predict. By relying on that bell curve, MPT models severely underestimate the probability of a true market crash. Practitioners have to compensate by adding their own constraints, like setting hard limits on how much can go into any one asset.
We have covered a huge amount of ground today, from the microscopic details of the tax code all the way to the macroscopic mathematical physics of how portfolios work.
We have. And we've established that effective financial planning is really about controlling what you can control. It's about minimizing the drag of costs, especially taxes, and minimizing volatility through diversification. Those are the twin pillars of building resilient wealth.
So the key actionable takeaways for you today are clear. Get your 3 tax buckets set up now. Aggressively fund that triple threat HSA and use the strategic reimbursement method. Look for that 0% capital gains bracket as a real target in your low-income years. Use the bunching technique to maximize your deductions every few years. And religiously practice portfolio rebalancing to keep your risk profile stable.
And here's the final provocative thought for you to chew on. Think of your tax strategies, the Roth conversions, the bunching, the capital gains harvesting. Don't think of them just as saving money. Think of it as optimizing the risk-reward profile of your future tax liability. You are intentionally choosing when to bear the tax risk, paying it now at a low rate, to maximize your ultimate tax-free return reward later on. The principles of modern portfolio theory, optimizing risk and return, they apply just as much to your tax planning as they do to your investment portfolio.
Knowledge is only valuable when it's actionable. We really hope this deep dive has given you those aha moments you need to take control of your financial future. The learning doesn't stop here, so if you found this valuable, make sure you subscribe to Money Mindset.